Hello students, welcome to Finance for Engineers course. In competitive business environment, in order to sustain in the competition, organization continuously needs to expand its business to new dimensions. For this, it has to go for expansion, replacement, and renewal of its capital assets. For this, organization needs to deploy long-term capital and it has to decide in which of the alternative they should fund. This initiates the concept of investment decision. One of the most important decisions for a financial manager is investment decision. So today I'm going to start new unit, that is unit number 4, investment decision rule. This unit talks about the investment decision, the process that companies use for decision making on capital projects with a life of a year or more. Significance of the investment decision. Also, it focuses on the answer to the questions like how business firms take investment decisions, what different tools or techniques it apply for evaluating the proposals or project. So let us start with the nature of investment decisions. The funds raised from various sources are very limited and therefore manager must make careful choices about when and where to invest capital to ensure that it is used wisely to create value for the firm. The process of making these decisions is called investment decision or capital budgeting decision. It is a method of estimating the financial viability of a capital investment over the life of investment. The firm's investment decisions would generally include expansion, acquisition, modernization, and replacement of the long term assets. See, this capital budgeting as a concept affects our daily lives too. Let us take an example that your mobile phone has stopped working. Now, you have two choices either buy a new one or get the same mobile repaired. Here, you may conclude that the cost of repairing the mobile increases the life of the phone. However, there could be a possibility that the cost to buy a new cell phone would be lesser than its repair cost. So, student, you decide to replace your cell phone and you proceed to look at different phones that fit to your budget. Same here, any business that seeks to invest its resources in a project without understanding the risk and return involved would be held as irresponsible by its owners or shareholders. Capital budgeting is a method of estimating the financial viability of a capital investment over the life of the investment. Capital investments are long-term investment in which assets involved have useful life of multiple years. For example, constructing a new production facility and Investing in machinery and equipment are some examples of capital investment. Thus, it can be said that capital budgeting is the process a business undertakes to evaluate potential major projects or investments. Construction of a new plant or big investment in an outside venture are some of the examples of projects that would require capital budgeting before they are approved or rejected. There are certain motives of capital budgeting or investment decision. First is expansion, that is, to extend the existing facility, there is a need of capital expenditure decision. Either it can be concerned with a new area or existing one. Second motive may be replacement. When a firm think of replacing the older facility with with new equipment, capital budgeting is prominent. Next is renewal. It is the alternative of replacement decision. In case of renewal, two very important matters need to be considered: repair and maintenance and rebuilding. Repair and maintenance is a recurring expenditure or revenue expenditure, while rebuilding is a capital expenditure. Now, next is classification of investment. Under that, first is mutually exclusive investment. Next, independent investment and contingent investment. The mutually exclusive investments, these are the investments serve the same purpose and compete with each other. That means if one investment is undertaken, others will have to be excluded. Example of this is if a company wants to purchase a machine, then they may either use a labor intensive semi automatic machine or highly automatic for production. Next is independent investment. These are the investment which serve different purposes and they do not compete with each other. For example, a heavy engineering company may be considering expansion of its plant capacity to manufacture a new production or can think of purchase of light commercial vehicle. So depending upon their profitability and availability of funds, the company can undertake both investment or either or. That means they may invest in a plant or they may think of purchasing a vehicle. So they are totally independent, not at all connected with one another. And the next is contingent investment. These are dependent projects. That means the choice of one investment requires undertaking one or more other investments. And the example is if a company decides to build a factory in a remote, backward area, it may have to invest in houses, roads, hospitals, schools, etc. So these are the three types of investments normally done by the organization. Now the next is importance of investment decision. First is long-term implications. Second is huge investment. It is irreversible decision. Next is risk and uncertainty. Next, complexity. Sixth, long-term effect on profitability. And finally, wealth maximization. So, 7 points are there which help us to understand the significance of investment decisions that's taken by the finance manager in the organization. So, let us see one by one. The first is long term implication. A capital budgeting decision or investment decision has its effect over a long term span and inevitably affects the company's future cost structure and growth. Therefore, a wrong decision can prove disastrous for the long term survival of a firm. On the other hand, lack of investment in assets would influence the competitive position of the firm. So, this capital budgeting decision is very important, which determine the future destiny of the firm. Second point is huge investment. Capital budgeting decision needs substantial amount of capital outlay, that is capital and investment, as the companies have limited resources. The company or firm has to make a wise or correct investment decision. The wrong decision would harm the sustainability of the business. Now, the third is irreversible decision. Generally, the capital budgeting decisions are the permanent decisions taken by the organization as it involves the large amount of investment, and such decisions cannot be reversed back in the future once they are taken. In most of the cases, capital budgeting decisions are irreversible because it is difficult to find a market for such assets. The only way out will be scrap the capital asset so acquired and incur heavy losses. Next is risk and uncertainty. Capital budgeting decision is surrounded by great number of uncertainties. Investment is present and the returns are greater, maybe the risk and uncertainty. The estimates about cost, revenue, and profits may not come true. Next is complexity. Capital budgeting decision making is very difficult and complicated exercise for the management. These decisions require an overall assessment of future events which are uncertain. It is really a tedious job to estimate the future benefits and cost correctly in quantitative terms, subject to the uncertainties caused by economic, political, social, and technological factors. Now, the next point is long term effect on profitability. Capital expenditure have great impact on business profitability in the long run. If the expenditures are incurred only after preparing capital budget properly, there is a possibility of increasing profitability of the firm. And finally, wealth maximization. The value of equity shareholders is increased by the acquisition of fixed assets through capital budgeting. A proper capital budget results in the optimum investment instead of over investment and under investment in fixed assets. The management chooses only most profitable capital projects which can have much value, and in this way the capital budgeting maximize the worth of equity shareholders. So these are certain points which help us to understand how important this investment decision, or alternatively we call it as a capital budgeting decision. Now let us see steps that are taken by the finance manager while taking investment decision or capital budgeting decision. The first stage is proposal generation. Proposals for new investment projects are made at all levels within a business organization, and they are reviewed by the finance personnel to understand the feasibility of the particular proposal. Second is review and analysis. Finance managers perform formal review and analysis to assess the merits of investment proposal. Next is decision making. Firms typically delegate capital expenditure decision making on the basis of dollar limits, that is the budget, how much budget we have with us, and how much investment we need to do in that particular project or proposal, and how much returns we can generate from the project. Next, implementation. Following approval, expenditures are made and projects implemented. Expenditures for a large project often occurs in a phases. And finally, follow up. Results are monitored and actual costs and benefits are compared with those that are expected. Action may be required if actual outcomes differ from projected ones. So these are the steps taken by the organization while accepting any investment proposal. It can be concerned with modernization, it can be concerned with replacement, it can be concerned with a new project or proposal. Now, the next point is investment decision rules. While accepting any project, the finance manager or the finance team has to think on these rules. That is, it should maximize the shareholders' wealth. The investment should consider all cash flows to determine the true profitability of the project. While taking this investment decision, it is necessary to provide for an objective and unambiguous way of separating good projects from the bad projects. That means one can easily identify that this is a good project, that is profitable project, and this is somehow a bad project which will not generate profit to the organization. It may turn in loss. It should help ranking of projects according to their true profitability. It should recognize the fact that bigger cash flows are preferable to smaller ones, and early cash flow are preferable to latter ones. It should help to choose among mutually exclusive projects, that project which maximize the shareholders' wealth. So these are certain important rules concerned with investment decision. Now, let us focus different techniques used for taking capital budgeting decision or investment decision. So there are two criteria First is non-discounted cash flow criteria, and next is discounted cash flow criteria. Now, non-discounted cash flow criteria are these techniques which never give significance to the time value of money, while discounted cash flow criteria techniques consider the important aspect of finance, that is time value of money. So let us first try to understand what is this time value of money. See, the time value of money is the concept that a sum of money is worth more now than the same sum will be at a future date due to its earning potential in the interim. This is a core principle of finance. A sum of money in the hand has greater value than the same sum to be paid in the future. That means it recognizes that the value of money is different at different point of time. Since money can be put to productive use, its value is different depending upon when it is received or paid. So I know that you must be finding it difficult to understand. So let us take an example that your friend is promised you to give you money, and he's giving you two options. First is to take rupees 10,000 today, or to take rupees 10,500 next year. Now, which one you will choose? That means you have two options, and which one you will choose now. So you have to think on this, and I think you will choose first option. Why? Because now you are not earning, and this rupees 10,000 means a lot for you. One needs to have money in hand when there is a need and an opportunity. But suddenly, if your friend changes his mind and tells you that I will pay you rupees 10,500 in next year. Now, now what to do? You may not be happy to accept this proposal because after 1 year, you may be doing job somewhere and earning well. This is one thing. Also, another factor affects on the value of money, that is inflation. As the time passes, there is decrease in the value of money. One should consider that the value of 1 rupee today is not equal to the value of 1 rupee at the end of 1 year or at the end of second year. In other words, we cannot assume that the value of rupee remains the same, and this is known as time value of money. And this non-discounted cash flow criteria never considers this aspect, that is time value of money, whereas discounted cash flow criteria considers the time value of money. So let us see the further classification, different techniques under these criteria. So under non-discounted cash flow criteria, we have payback method and accounting rate of return method. In case of discounted cash flow criteria, we have net present value method, profitability index method, which is also called as benefit cost ratio, and next is internal rate of return method. So these are the 5 techniques that are used by the organization for while considering the capital budgeting decision or while evaluating a particular investment decision. So let us start with first non-discounted cash flow criteria under the payback method. As the name suggests, this method refers to the period in which the proposal will generate cash to recover the initial investment made. It purely emphasizes on the cash inflows, economic life of the project, and the investment made in the project with no consideration to time value of money. However, as the method is based on thumb rule, it does not consider the importance of time value of money, and so the relevant dimensions of profitability. It measures only the number of years required for a firm to recover its initial investment in a project as calculated from cash inflows. And the formula used for calculating this payback period is initial investment divided by annual cash inflow. And we have accept or reject the criteria. We will accept a particular proposal if the actual payback period is less than the predetermined payback period. And we will reject investment proposal if it would not happen. That means the actual payback period is more than the predetermined payback period. And now let us start with the first example. Following is the information given regarding the cash inflow and outflow concerning to a project A. You can see here rows and columns table is given in that years 0 to 5 and project A. Against it some figures are there which indicate cash inflow and outflow. So the figure into bracket shows cash outflow, that is initial investment required for a project A. That means this 10 lakh rupees the firm has to invest into a particular project A, and from first year to fifth year, this particular project A will generate this cash inflow or income the firm can generate from this project A. That is 2,50,000 every year. And you are required to calculate payback period of the project A. So how to calculate this payback period? So as they have given information concerned with cash inflow and outflow, we can just put the figures into the formula given. So let us see the solution. Now this is a formula. Payback period is equal to initial investment divided by annual cash inflow. So we know very well how much is the initial investment. So initial investment is 10 lakh rupees divided by annual cash flow 2,50,000. So payback period here is 4 years. That means at the end of fourth year, the particular project A is giving back whatever amount we are investing in that particular project. In that particular project, so payback period of this project A is 4 years. Now it is up to the organization whether to accept this particular project or reject, because here there is no information given concerned with a predetermined period. So this is very simple when the same amount the particular project is generating every year. But if it changes, if the cash inflow changes from one year to another year, then how to calculate the payback period. So let us see the second example. The following is the information regarding cash inflow and outflow concerning to project B. And here is the information. And here you can see data 0 to 4 year, and project B 10,000 is the initial investment, that is where written in a bracket. And in first year, this particular project will generate 5,000 cash inflow or income. In second year, we can earn 2,500. Third year, 4,000. And in the fourth year, 1,000. So this is income from project B in next 4 years. So you are required to calculate the payback period of project B. Now, how to calculate the payback period for this uneven amount of cash inflow? So again, here we will apply the formula, but for that, first we will think on the data, whatever is given concerned with cash inflow. So first we will write the formula. Payback period is equal to initial investment divided by annual cash inflow. Now the next thing is try to identify the payback period where it may lie. That is, here in case of project B, the payback period lies between second and third year. That means uh, in a first year we are getting 5,000. In a second year we are getting 2,500. So if we add 5,000 and 2,500, we get 7,500. And in a third year, we are getting 4,000. That means definitely if we add this 4,000 to 7,500, it exceeds to 10,000. That means the exact period, payback period, must be lying between the second and the third year. So see how to present this. Sum of money recovered by the end of second year is 7,500. That is 5,000 and 2,500. So payback period, by applying formula, how we can present this? 2 plus into bracket, square bracket. We will write 10,000, that is initial investment, minus 7,500, that is we are getting at the end of second year, divided by 4,000, that is the annual cash flow of third year. Annual cash flow of third year we are considering here, and by solving this equation we get 2.625 years is the payback period. That means whatever we have assumed, we have written, that is the period, payback period will lie between second and third year. Yes, it is between the 2 years. That means more than 2 years but less than 3 years is the payback period. So 2.625 year is a payback period for project B. In this way, we have to solve such type of examples. Moving further, we will see the third example. Now here, Beta Private Limited, Pune is considering an investment proposal to install new milling control at a cost of rupees 50,000. The facility has a life expectancy of 5 years and no salvage value. The tax rate is 35%. Assume the firm uses straight line depreciation and the same is allowed for tax purposes. The estimated cash flows before depreciation and tax from the investment proposal are as follows. Now here you can see two columns, year and CFBT. What is this CFBT? That is cash flow before depreciation and tax. Now here the life of a particular proposal is 5 years. So 1 to 5 year data is presented, and against that you can see amount is given, that is cash flow before depreciation and tax. In a first year it is 10,000, in second year 10,692, in third year 12,769, in fourth year 13,462, and fifth year 20,385. And here you are required to calculate or compute payback period. Now you can see so many things as mentioned here. In earlier problem, we have seen only two type of information. One is cash inflow and second is cash outflow. But here they have mentioned cash inflow, cash outflow, but along with that, life 5 year, no salvage value, tax rate is given, and even straight line method of depreciation. So additional information is given to us and expected to calculate payback period. Now, in such type of problem, we need to prepare a statement that will show cash inflow before tax after depreciation. So how to present that? So let us start with the solution. Statement showing cash flow after tax before depreciation, which is written as CF80. And here you can see the presentation of the data. Now, first is a particular column, and then I have written 5 years, 1 to 5 years I mentioned, and then started with CFBT, that is the information they have presented in a example. But that was in a vertical format. Now here we have converted it into horizontal format. CFBT, first year 10,000, second year 10,692, third year 12,769, fourth year 13,462, and fifth year 20,385. Less depreciation. Now here you are required to calculate depreciation. So what information they provided to you? Straight line method of depreciation used by the organization. There is no salvage value and initial investment is 50,000. And we know the life of the asset or a proposal is 5 years. So by using this information, we should be able to calculate depreciation. So you should know the formula for calculating depreciation, that is initial investment or cost of an asset minus salvage value, which is also called as a scrap value, divided by the life of a asset. So here 50,000 is initial investment. There is no salvage value, that means zero. So 50,000 minus zero divided by life of an asset is 5 years. So that's why written 50,000 divided by 5. And straight line method of depreciation, that means same amount will be carried by the organization for whole life of the asset. So same amount of depreciation we have to write for 5 years. It is 10,000. Now we are deducting depreciation from cash flow. So we will write it as a profit before tax or cash flow before tax. And you can see here the calculation. Then we will deduct tax, and tax rate is already given in an example, 35%. Now there should not be any confusion on which figure to calculate tax. We have to calculate tax on PBT, that is profit figure, which we have arrived now. On that we will calculate 35%, and then we arrive at profit after tax. So we are deducting tax amount from profit before tax, and we arrive at PAT, that is PAT. After that, we have to add back depreciation. As this is a non-cash item, organization again add back this depreciation, and now we arrive at cash flow after tax before depreciation. Why before depreciation? Because we are adding back depreciation. But it is necessary to first deduct depreciation, then deduct tax, and then again add back depreciation. Because after deducting depreciation, the amount of profit get reduced. And on that reduced balance, we will pay tax, and then again we will add back depreciation, because we are not paying depreciation to anybody else. It is a non-cash expense. The amount lies with the firm only, and that's why we are adding back this depreciation figure. So in this way, we have calculated cash flow after tax. Now, what to do with this figure? We have to prepare a statement which will show cumulative cash flow after tax. So this is a cumulative 3 columns. First is year, next is CF80, and then cumulative of CF80. And when you observe this cumulative CF80, you will understand that where this payback period will lie. Now, amount whichever we are investing is 50,000. Okay, so you can see here the payback period will lie between these 2 years. That means fourth and fifth year, because at fourth year we are getting 44,500, and in fifth year we are getting 61,250. That means the period will lie between, this payback period will lie between fourth and fifth year. So let us see by applying payback period formula. So here you can see fourth plus in a square bracket. Again, we are writing in a bracket 50,000 minus 44,500. That is the amount which we are getting at a fourth year, divided by this amount, 16,750 annual cash inflow, and not this the cumulative one. Okay, so annual cash inflow is 16,750. We are considering here, that is annual cash inflow. So what is the formula? Initial investment divided by annual cash inflow. So initial investment 50,000, but from that 50,000 we are getting 44,500 till fourth year. So we are deducting, deducting that, and then we are dividing annual cash inflow of fifth year. So by solving this equation, we get the answer 4.328 years. That means whatever amount we are investing, that is 50,000, we will get back after 4 years. So this is too much time taken by this particular project. So the machinery. So it depends on the organization whether to accept or reject the proposal, but too much time is taken by this particular asset for paying back the amount of investment. So this is about the payback period, first technique used for evaluating the capital budgeting project or investment projects. So I'm ending my session here, and we will discuss another techniques in next lecture. Thank you.